recording sales transactions using a general journal. So 11-2, we're going to record sales returns and allowances. So this is different than 11-1, where recorded purchases, returns, and allowance. So when we purchased something and returned it. Now we're talking about when our company sells something and that customer returns it. So we're going to be using the general journal again today. And we're also going to be recording correcting entries. So it's important to know the difference between a sales return and a sales allowance. A sales return is when we credit a customer's account. So this is when we have accounts receivable, meaning a company owes us money. Accounts receivable decreases with a credit. So if we decrease the accounts receivable because someone returns items, so for whatever reason, they give us back the merchandise and we decrease the amount that they owe us. Sales allowance, that's the situation where maybe we sent them damaged merchandise and they shouldn't have to pay for damaged merchandise, but it's also really not worth our time or our money to have to deal with shipping it back to us, for instance. So we may also credit or decrease the accounts receivable account, but not actually get a return. So that's sales allowance. So we'll still decrease the amount that they owe us, but there's no return involved. So when this happens, a credit memorandum will be completed. This is a form that would be filled out to show what was returned and how much the value is of that item. So here's an example of a credit memorandum. So you could see that they returned 3 batteries, the price of those batteries, and then it also shows the sales tax. So it's important to know our total amounts and also the company that we need to decrease how much they owe us by crediting their account. So here's how we journalize this transaction. Sales returns and allowances and sales tax are going to be debited, and then we're going to credit the accounts receivable account to decrease the amount that they owe us. So it's a 3-line entry, starting with the date, and then we're debiting sales returns and allowances for the value of the items. Credit memorandum number 14. And then we're also debiting sales tax payable to decrease that liability. And then finally, we want to make sure that we credit accounts receivable. We want to include that diagonal line because we're going to have 2 accounts that we need to post for the total of the merchandise return plus the sales tax. So when we post this, the main difference when we post this is that we need to make sure anytime we have a diagonal line, accounts receivable, / Lake Automotive, we have our / here, we want to make sure that we record this in both spots. So record it in the accounts receivable controlling account as well as in Lake Automotive's account. So that is the difference when we post this, just like when we did this yesterday in 11-1. 11-2, we also have that diagonal line that we need to post to 2 accounts on the same row. Our correcting errors in the subsidiary ledger accounts is important. So when we make an error in the journal, we can't just go back to the journal, erase it, and write the correct account because that number has already been posted, so the ledger is not accurate. So we need to do something called a correcting entry. So in this example, we should have debited Skinner College on December 26th, but instead we accidentally did Wells Apartments. So what we need to do is we need to debit Skinner College like we should have done initially. So that's what we should have done. Line number 1, debit Skinner College for a debit of $334. The second half of the transaction is we need to cancel out our error. So we in error debited Wells Apartments, so we cancel out a debit for $334 by crediting it for $334. So that is why we are doing this transaction. So then when we go to post here in the blue ledgers, you can see that Skinner College, when we post that now, it's the updated correct account balance that they owe. And then Wells Apartments decreases the amount that they owe so that that is accurate as well. I think it's important to talk about the difference between sales return and sales allowance. So you have this question in the bottom of your note guides, if you could answer that, as well as question number 2. The difference between sales return and sales allowance. Sales return requires that something actually, the merchandise actually be physically handed back to us. Sales allowance, That's when we credit or decrease the amount that a company owes us, but they're not physically giving us anything back. So maybe we said that we were going to ship them 10 items, but there was an error and only 8 items got shipped. Well, we're going to credit their account for those 2 that didn't get there. So even though they didn't physically give us anything back, we're still going to credit their account to decrease the amount that they owe us because they didn't actually get what they ordered. And then it's important that the source document for journalizing sales returns and allowances, that is a credit memorandum, and it associates with the fact that we're crediting our accounts receivable to decrease the amount that these companies owe us. And that is a section 11-2.